So you think you got options all figured out, right? It's easy, you think to yourself. If the stock price gigapumps, then call options are going to the moon, and vice versa for puts. Surely it can't backfire, right? Well, there's exceptions. For instance, the stock went up 32% today, so obviously that means call options went to Uranus, and put holders are crying, right? Right?
Wrong.
Hold that thought. We'll come back to it. Trust me, you don't want to end up like this galaxy brain from Wall Street Bets. That said, this topic of options pricing can get pretty complex. In fact, there's countless textbooks written on this exact topic, like this one I randomly came across. No idea if it's good or not, but the dude definitely looks more qualified and less regarded than me. Speaking of which, I'm regarded, and this is not financial advice. To keep this video relatively simple and concise, we'll be ignoring the Greeks for now. Let's just focus on the concept of implied volatility. So what is it? Okay, great. Video complete. Bye. Just kidding. Look, I know what you're thinking. That was boring as shit, and I got lost after the first sentence. Don't worry, I got you. Here's my take on implied volatility as it relates to options. It's a very important concept, so I would listen up. You are not betting on whether a stock will go up or down. Instead, you're betting on whether you think the stock will go up or down more than the market consensus. Or put another way, in order to win at options, you need to be right in direction, timing, and you need to beat the market's expectation on the magnitude of the move. For instance, if you bought Tesla options that's pricing in a 10% move for earnings, and it moves up after earnings by say 8%, even though you got the direction and timing right, you still lose. The Theta Gang sends their regards. Do you need a real example that we can study from? Don't worry, I got you. Check out this stock, ANVS. It's a biotech stock that moved up 32% in a day. I know you're probably thinking along the lines of, wow, if I had bought calls, I'd be crushing it. And if I had puts, then GG, I lost all my money. Hold that thought and check this out. Super fascinating. These ANVS call options expiring in a few weeks went from out the money to in the money. But yet it only went up 46% on pretty high volume. Now, don't get me wrong, it's a lot, but keep in mind the stock went up nearly that much. So in that context, the gains on the calls are not as great as you would expect. Conversely, if you had held puts, you would think it would probably lose 99% of its value since the stock went up so much. But nope, the puts are down less than 10% on the day. Let me recap that for you in case you didn't catch that. The stock went up 32% and the put options barely lost any value. So why are the options acting this way? 2 words, implied volatility. More specifically, this company has FDA data readout that's coming out soon. This is significant because typically these events are binary in nature, meaning the company either dumps massively on bad results or vice versa. Therefore, the options market will be pricing in this massive movement around this event. As a result, the implied volatility on these options are at a disgusting 500%. Just for comparison's sake, Tesla's option IV is currently at 50%. So in conclusion, options may not always be the most optimal move to make. For instance, if you believe a stock will go up within a certain time frame, depending on the IV and how expensive the options are, you could potentially outperform options by using other strategies, such as buying the common stock with margin.